And we're seeing that in the way stock markets are moving as well. Atul, you've been very big on the demographic story as well, and you've also been tracking really how all of this is going to stack up to move markets higher. Give us your perspective, and also how, taking off from what Bala said, this is really going to be driven by the domestic story, and it's really going to be some of the old cyclical plays that are going to come back and really capitalize on that.
Thanks. So let's put things in perspective. As the markets stand, we talk about Nifty. It's a good index we all follow. It's at 18,100. About a year ago, we were at lifetime highs, which was 18,600. So essentially, the distance from lifetime high is 3%, which is pretty good. Why I say that is because if you look at, we know a lot happening in China. The Hong Kong market is 40% from lifetime highs, right? Tech, NASDAQ, absolute sweetheart. Everyone wanted to invest in a NASDAQ ETF. Everyone wanted US exposure. The NASDAQ in the last 1 year is 30% from lifetime highs. S&P 500, the top 500 US corporates, 20% from lifetime highs. So if you really go and see that among the top 20 to 25 global markets, the market nearest to lifetime highs, means showing relative strength, is actually India. So there is a method in the market, or as a belief system, that stocks that fall less in falling markets are leaders of the next bull market. I want you to reflect on it. It's a big takeaway. That the real test of markets, stocks, companies and industries are in difficult times. And those stocks, those industries that fall less in bear markets, actually when markets turn around, are leaders. And that is a characteristic India is showing. So the last 1 year has been a global bear market. I put out some numbers for you. But India is the markets that fallen the least. So in my 30 years that I've been in the markets, I have never seen this. And let me add on another negative point. That in this last 1 year, the total FII selling in this country has been $50 billion. So whenever FIIs used to sell, Indian markets used to tank. What's happened here? How come we've fallen so much less than global markets in spite of a $50 billion sell number by FIIs? What shifted? The shift is that there have been almost 40 billion that have come in from domestic flows. Every time over the last 30 years, I've been a broker, I've seen it at retail, institutional levels, whatever. Whenever markets tanked, Indian investors ran out of the door. FII bech raha hai, nikal jao, bhag jao. Markets are going to crash. But this is the first time that in fact we have seen positive flows. So now I want to think that, hey, what's happened here? Why aren't Indian investors panicking? How come they're adding on 40 billion? And we all talk of this demographic shift. We refer to it other industries, etc. But the biggest beneficiary of the demographic shift is happening in India, in Indian markets and Indian investment patterns. When I invested in the market, probably in my full family generation, I was the first guy who ever bought a stock. But today when I speak to my cousins, family, friends, even people with a salary of 10 to 15,000, they have a 1,000 rupee systematic investment plan going to mutual funds. So that is demographics and play. And if these habits come in when you are at 25, 30 years of age, the runway is the next 20 years. So the biggest beneficiary of demographic shifts is going to be this domestic flows. And we've seen this in the US. Between 1980 and 2000, the Dow was 1,000 in 1980. It got to 10,000. And what was the shift? Was this demographic play. I'll just end by a beautiful line my mentor told me, Rakesh Jhunjhunwala. Before he passed away, I was with him one day. And he says, Atul, sab पूछते हैं अपना time कब आएगा? Saying, beta, अपना time आ गया है. That is the shift. That is the demographic shift. And that is why we are a market that's fallen less. We will be the first to break out to lifetime highs. And I feel that we are entering a decade of leadership backed by this big demographic shift propelled by domestic investors.
Absolutely. I think the biggest, vindication of that is the way markets have been resilient and continuing to test new highs. The retail investor hasn't looked as shaky or as nervous as one would have anticipated. Since we have, a limited amount of time left, I'm not going to go to the concerns. I'm actually going to go to what everyone wants to know, and that's what should they buy, right? So Rhythm, and I know you're going to talk to me about long-term plays and it's a 20-year story, but what are you seeing as the big opportunities for the next couple of decades?
So just before I go there, I'll just supplement one point that Atul made, because that's a very important point on the domestic bid. It has actually altered India's macro. So the transition actually happened in January 2015. And people have forgotten about this. That was when the Modi government, for the first time in India's history, allowed retirement funds, which is provident funds and national pension scheme, to buy stocks. They are buyers every month because they only get inflows. And people underestimate the importance of having such consistent buying. The same thing happened in 1980 in America. President Reagan had allowed 401k plans to buy stocks. Until then, 401k plans were not allowed to buy. And then you got a 20-year bull market in America, domestic flows as well as rising share prices. So I keep telling people, because there's huge skepticism about the domestic investors, we're still very, very early in this game. It's going to last for 2-3 decades, So it's a...
Everyone asks me, how long are you going to live in this fairy tale world of domestic investors investing? Kabhi to negative hoga. And they've been waiting for the last 14 months. And every month, they're getting surprised. But that's the way it is.
On the sidelines, Atul and I were discussing about the Harshad Mehta bull market. In 1992 or 1991, households put 25% of their saving into equities. Okay? Indian households have always liked to buy equities. Then the market crashed and that whole generation went away from equities. They got scarred. If I take today's saving pool and compute 25%, that's a whopping $200 billion. Okay, we're not even at the tip of the iceberg of what domestics can do with their portfolios and buy stocks.
So it's because yeah. Go ahead, Bala.
The way we contributed as a mutual fund industry. So you mentioned about 1992 Ashwin scam. Maybe the mutual fund size would have been about 40,000 crores or something, 40,000 crores or 50,000 crores. Today we are sitting at 20 lakh crore size, and it's still growing only. So that's something what you say, that's the hard work and the belief and faith and of course the experience. All of them do matter. And also the future. As long as the future is bright, confidence remains high. So that's something I think what you said, all of us said about the culture is changing.
But I was going to say, clearly equities have become the asset of choice.
So I think investors should focus on businesses that are facing inside India, which will benefit from the coming growth rates. The quintessential sector for everybody to buy is financial services. It kind of benefits the most. We think, credit to GDP in India is 57%. Even adjusted for our low per capita income, this is really low. China's credit to GDP, private credit to GDP, is 225%. So just imagine the difference here. And the US is also a number well past 200. So Indians are going to borrow more money. Indian companies are going to borrow more money. So I think financial services. The other place is consumption. You asked this question to Bala. So I think India has a very unique position in the world. We have consumers at every level of the income strata. Right at the bottom, people who are struggling to meet their two ends meet and who are also sleeping hungry. And at the top, people who are going to take vacations abroad and buy Louis Vuitton purses. Everybody is going to go up the consumption bar. So I think consumption and financial services will be my two pointed bets. There will also be a set of companies that will benefit from the fact that the typical CEO in the world now is comfortable about work from home. And it's better to work in Mumbai than Florida. It's a whole lot cheaper. So companies that get exposed to those trends will also do well in my view.
So since we've talked about this being a domestic driven story now, if there was one domestic risk, let's forget the global factors for a moment, one potential risk back home that could disrupt this entire story, what would it be?
I think it's the price of commodities. I think we all know that how important crude is. It's our largest import bill. And I also look at global commodities and the way they are panning out. So the global risk is truly inflation. And the fact is that commodities, and especially the way crude is behaving, is something that worries me. And crude, I think, is not a function of demand and supply global. There's so much geopolitics involved. Saudi, Russia, US. So I think that what I would be worried about is the way commodities are shaping up. I would have thought that crude has no business to be at $90, $95 Brent. I think it should be nearer to 65, 70. But I am getting challenged. I'm getting challenged. And my fear is that if we head back, if we pull up, as I said, it's more due to geopolitics than demand and supply. I think that could sour India and Indian macros. But Abha, that will be a short-term cyclical risk. It doesn't take away from the longer-term story, which I still think is a very big demographic story. It's almost like a decadal kind of move that we are likely to see.
One more I'll put in the mix is to 2024 elections. Okay, we have forgotten that the electorate can put a minority government back. And in, I think 2004, May is a good template. The stock market went down 17% in a single day, went down 30% in the subsequent 4 months. And it took a while for us to get back. And the global markets were in a boom phase that time, so it was very different. So what happens in 24 elections will be, I think, important. It won't be a small event risk for the market.
The third thing it could be I think interest rate structure is getting changed. I think we can't ignore it. Which essentially means as interest rate goes up, the cost of capital goes up, the return on investment comes down. I think we may go through that cycles. Therefore, what Atul mentioned about, Rhythm mentioned about, the short term, we may face these kind of risk. Therefore, making an assumption that yes, equity will continue to give return and go through a cycle, that also need to be understood. But long-term bullish, but short-term we may see this kind of volatility setting in.
So since we're still seeing short-term volatility, I don't know what target to ask you for. I always ask Atul every Diwali, every New Year. So I'm going to try it with him first and then come to you, Rhythm. I know you won't give me necessarily a target. But Atul, with all this volatility, what should I ask you? Financial year end?
I mean, see, it's targets, when I'm talking about a decadal bull market, honestly, Abha, giving targets, etc., doesn't matter. But yeah, if you look at it at a 1-year time horizon, I have been on record and I'm talking about Nifty because that's what we track. Yeah. It's 18,000 right now, 18,100. So I think we'll see about a 21,500 kind of move, which could be a 20% kind of up move from here. I think that's pretty good because your comparative assets are nowhere near that. So I personally feel that, and there's a lot more that you would make through stocks. I feel a lot of sectors will do very well. I mean, just to take from where you are, we are down 3%, as I said, on a 1-year basis. But something like capital goods, a very broad sector, is up 25%. So as a direct equity investor, there's no reason why you cannot outperform or do much better than that, which I think is a fantastic opportunity in Indian markets.
20 to 25% is pretty good. Rhythm?
See, Abba, I will not get drawn into this at all because I'll tell you why. It's of no use to anybody. Okay? The better thing for me to say here is look for good businesses managed by good people, trading at reasonable prices, and just be happy. Okay,
but at least tell me if you're agreeing with the 20 to 25% or 10 to 15 on your radar.
No, actually, I don't want to get drawn into it. I'll tell you why. Because as we've seen in the last 1 year, the stock markets are down 3% in India, yet we all feel that it's a bull market. We're down, we're not up. Yeah. Okay, it's not going to be a good year. This year is a bad year for stocks. Okay, and yet we feel like we're in a bull market. The reason is because everything else looks bad. I have no idea what everything else is going to do. Okay, what if everything else goes up 20%? What if everything else goes down 20%? We don't know. So I think the problem with returns is it's all in the context of a relative, so let's not really, I think, we should not ask people for targets. We should ask them what you should do with your portfolios. Buy.
Just if you can just elaborate on that.
Closing comment.
I don't think any of the people sitting on the floor would have actually estimated index will be at 18,000, Nifty, RDB, Sense would be about 60,000. Had you asked us about 10 years back? So any period you analyze, I don't think anybody would have got it right. Therefore, it is actually a futile exercise to put a number where it would be. But one thing remains constant ever in the stock market is the compounding effect. Yeah. Whether you take 8% compounding or 10% compounding or 14% compounding, with the GDP plus nominal, if you take the compounding, that is the real number, it will fructify. The question is, over a period of time, it does materializes. Therefore, rather than predicting where the index would be, have a conviction that yes, compounding effect could definitely come in the market. Yeah. Therefore, add up the number, it will lead to the number what is also talking about it.
All right, gentlemen. Buy, buy, buy. That's the clear headline coming out of this panel. How?
said not BYE, BUY.
Yes, thank you so much, all of you. Great having this powerhouse of a markets panel with us today, and the conviction on India really comes through. Thank you so much.